Learning accounting starts with mastering the concept of account, T-account, debits, and credits. Yet, many struggle to grasp it as it's not always fully explainable through straightforward logic. In today's video, I will show you how to learn these topics in an easy way. In accounting, the T-account is a fundamental tool used to visualize transactions and understand how they affect different accounts in the double-entry bookkeeping system. It's called a T-account because of its shape. It looks like the letter T. This structure helps accountants record and analyze debits and credits in a clear, organized manner. What is an account? In accounting, an account is a record that tracks and summarizes all the financial transactions related to a specific asset, liability, equity, revenue, or expense. Think of it as a detailed history book for every category of financial activity within a business or organization. Each account can show increases or decreases in the value of what it represents, such as cash, inventory, or sales revenue. For example, a cash account records all inflows and outflows of money. A revenue account tracks the income earned from selling products or services. An expense account logs costs like rent, salaries, and utilities. A chart of accounts is essentially the organized list of all the accounts in the general ledger. It is a structured list of all the accounts used by a business to record financial transactions. It acts as an organizational tool, categorizing accounts into groups such as assets, liability, owner equity, revenue, expense. Each account within the chart is typically assigned a unique number or code for easy identification. What is the general ledger? A ledger is a group of accounts. There is a separate account for each asset, liability, owner equity, revenue, and expense. The general ledger is a record of all a business's financial activities. It keeps track of things like money, debts, income, and expenses, giving a clear overview of the company's finances. The general ledger compiles all financial accounts and transactions. What is a T-account? A T-account is a visual tool in accounting that resembles the shape of the letter T. It provides a clear way to differentiate between debits and credits. Every account has its own T. The left side of the T is where the debits go. Credits go on the right side. Debit and credit do not mean plus or minus. It literally just means debit goes to the left side of a T account and credit goes to the right side of a T account. Debit means left, credit means right. This format helps in organizing and analyzing journal entries for recording transactions in the double-entry bookkeeping system. Essentially, a T account acts as a simplified balance sheet, focusing on a single account within the ledger. It consists of title, the name of the account at the top. Left side is the debit side. Right side is the credit side. Why use T-accounts? T-accounts are valuable tools for identifying errors or trends within the general ledger. By providing a clear and straightforward visual representation of transactions, they are especially helpful for beginners in accounting. However, as accountants become more experienced, they tend to shift away from using T-accounts and instead focus on analyzing financial data directly within accounting software. What is a business transaction? A business transaction is always an exchange of things of value. Something of value is given. Something of value is received. Before recording any transaction, you must answer 2 questions. Which accounts are affected? Did accounts go up or down? To answer question number 2, you need to understand if an account is a debit or a credit account. For every transaction, the total amount of debits must equal the total amount of credits. If you debit an account for $50, you must credit another one with $50. There can be more than 2 accounts involved in a transaction, but never less than 2. A business's operations directly impact its balance sheet by altering assets, liabilities, and equity. Each business transaction influences multiple elements of the balance sheet due to the double-entry bookkeeping system, ensuring financial records stay balanced. Which accounts are debits and which credits? The dealer rule helps you understand how different accounts behave. Dividends. That's when the company distributes its profit and cash to the owners. Expenses. That's money we pay for goods or services the business purchased. Assets. That's the resources the company owns and uses, like buildings, machines, equipment, and so on. Liabilities, which is money we still owe to others, like to the bank, to suppliers, or to the IRS. Equity. That's the money the owners of the company put into the business. Revenue. That's the money we receive for sales to our customers. Dividends, expenses, and assets in their natural state have a debit balance and increase with debits. Liabilities, equity, and revenues in their natural state have a credit balance and increase with credits. What is double-entry bookkeeping? Double-entry bookkeeping guarantees that each transaction affects at least 2 accounts, with equal amounts recorded as debits and credits. In accounting, debits and credits are always paired, ensuring that every transaction impacts at least 2 accounts. When one account is debited, another account must be credited. Just think of it like a bank transfer. When you send someone money, it comes out of your bank account and it goes into their account. Here's a few examples how different business activities influence the balance sheet and double-entry bookkeeping. An owner invests $5,000 in a business. Which accounts are affected? Cash and capital. Did accounts go up or down? Increasing both. Cash is an asset. Asset natural state is debit. Increase in debit side and capital natural state is credit and increase in credit side. Purchase $25 worth of office supply within 30 days to pay. Which accounts are affected? Supplies and accounts payable. Did accounts go up or down? Increasing both. Supplies is an asset. Asset natural state is debit. Increase in debit side and accounts payable is a liability. The liability's natural state is credit. Increase in credit side. The business takes a $200 loan. Which accounts are affected? Cash and loans payable. Did accounts go up or down? Increasing both. Cash is an asset. Asset natural state is debit. Increase in debit side. Loans payable is a liability. The liability's natural state is credit. Increase in credit side. Received $500 cash as payments on account from a customer. Which accounts are affected? Cash and account receivable. Did accounts go up or down? Cash increased. Account receivable decreased. Increasing cash. Cash is an asset. Asset natural state is debit. Increase in debit side. Reducing account receivable. Account receivable is an asset. Asset natural state is debit. Increase in debit side and decreasing in credit side. Paid $70 cash, now due to equipment previously purchased but not paid for. Which accounts are affected? Account payable and cash. Did accounts go up or down? Reducing both. Account payable is a liability. The liability's natural state is credit. Increase in credit side and decrease in debit side. Cash is an asset. Asset natural state is debit. Increase in debit side and decreasing in credit side. A client payment of $150 for services rendered. Which accounts are affected? Cash and revenue. Did accounts go up or down? Increases both. Cash is an asset. Asset natural state is debit. Increase in debit side. Revenue's natural state is credit. Increase in credit side. Balance of a T account. The balance is basically the total of an account. To calculate the balance or total for the accounts, we add up the amounts on the debit and credit side for each account separately. For example, cash account has been debited means inflows of money. In June 1st received $100,000 and in June 5th received $5,000. That is why it is recorded on the left side, debit side of cash account. Total of debit side is $100,000 plus $5,000 equals $105,000. However, in June 1st, we spend $70,000. In June 2nd, we spend $5,000, and again in June 3rd, we spend $2,800. That is why it is recorded on the right side, on the credit side, which shows outflows of money. The total credit side is $70,000 plus $5,000 plus $2,800 equals $77,800. To find out the final balance, we deduct the smaller sum of credits from the bigger total of debits, which gives us $105,000 minus $77,800 equals $27,200. In accounting, we call this a debit balance of $27,200. Account payable account, it's the opposite. Account payable is a liability. The liability's natural state is credit. Increase in credit side and decrease in debit side. In June 2nd, we had $2,800 debt, and again in June 3rd, we had $5,600 debt. Recorded in credit side, because account payable's natural state is credit. Increase in credit side. Account payable account has a credit total of $2,800 plus $5,600 equals the total of $8,400 in credit side. In June 3rd, we paid back $2,200 of our debt. That is why it is recorded on the debit side. Remember, account payable is a liability. The liability's natural state is credit. Increase in credit side and decrease in debit side. The total of debits is $2,200. Again, we deduct the smaller one from the bigger one. Account payable has a credit balance, $8,400 minus $2,200 equals the total of $6,200. The balance of cash accounts increases with the debit, while the balance of account payable account decreases with the debit. And that's how we learned about account, T account, double entry, debit, and credit. I hope you enjoyed the video. A practice file is provided in the following video. Please watch the practice video to better understand the concept and function of account, T account, debits, and credits. If you enjoyed this video, don't forget to hit that like button. It really helps the channel grow. Share this with your friends who might love this too. And if you haven't already, subscribe and turn on notifications so you never miss out on exciting new content. Your support means the world to me, and I can't wait to keep bringing you more.